What exactly are the key metrics driving success in the property market? I'm Mike Loder. Investment Insights starts now. Welcome back to Investment Insights, presented by The Investor's Way, where each episode we put the power back in your hands to master your money. It's good to have Andrew Woodward joining me from The Investor's Way. Mate, Australians have a deep love for property investing. Take us through a little bit about this romance we have.
Yeah, look, it stems from two main factors. Obviously, housing provides security.
Yeah.
It's bricks and mortar. We can see it,
Tangible.
we can touch it, we can drive past it. We love it. And then obviously the financial side of it is that historically in this country, property market doubles every 9 to 10 years. It's been a fantastic wealth creator for so many people that it's hard not to love the property market. And I love it. It's where I made my first $1 million. It's what people have successfully built great generational wealth with.
That was the other point I was going to make. The generational aspect of it is hard to ignore. But residential property is obviously the most popular. But what other opportunities or options are helping people grow their wealth outside of it?
Well, most people are traditionally residential investors, and there's some interesting statistics around residential investing in that less than 20% of property investors buy a second or more investment. So if you've got 3 or more property investments, you're in the top 5 property investors in the country in terms of the number. So residential property, very, very strong and popular. Then you've got commercial property, slightly higher risk, much higher returns if you're fortunate, which in a lot of cases is beyond your standard retail investor, your mum and dad type investor, because it's just a larger outlay, although residential is getting close these days as well. So commercial has been less used by most property investors, but it's still a strong category. And then in more recent time, we've seen the, branches created like NDIS properties. So where we're providing a social solution for a part of the community that hasn't been well looked after in the past. So we're providing properties that are purpose built. Then again, because of population growth, lack of new builds, lack of land and so forth in this country that is sustainable, we've seen co-living, where we're getting multiple lettable areas within one property, and you can generate multiple rents and provide a space for people that is not necessarily taking on a whole home or a whole unit, and giving them a solution as well. And then in more recent times, we've now started to see fractional property investing, where people can buy a fraction of a property with a bunch of other people. And so instead of having to have $1 million outlay to get into a property, you might invest only 5% to get your share of that property.
So what are some of the key differences in these types of property investments? Do you have any that you sort of tend to favour, or does it depend on what age bracket you're at, how much money you've got, obviously, as well?
Yeah, the age is a big one in terms of, property is a long-term investment. We're taking, most of the time people are taking on mortgages to get into the property market. So you have to have that long-term view in order to be able to pay that mortgage down. And so that's a big factor in the decision-making process, but also your risk tolerance. So they all have different risks. And so you may not be open to a commercial property because you're not comfortable or may not have the cash flow to potentially fund a long period of time where the commercial property is empty. We're moving into a period of time where we're seeing more and more businesses move out of the physical locations.
You just have to drive down High Street anywhere and it's like for lease, for sale,
That's
for
it.
lease, for sale.
So that is a period for a lot of investors that they can't cover, and so that becomes too high a risk. And so risk and return is a huge component as to which one makes sense. So we've just listed off 5 choices. Yeah. And so you've got to work out, based on the length of time to your retirement goal and your available cash flow and your serviceability, in terms of which one is most appropriate for you.
Can we touch on self-managed super funds? I understand they're now able to invest in property. How is that changing the game and moving the pieces a little bit?
It's, for me, in terms of what I'm seeing in that space, is that the self-managed super fund is becoming a really powerful tool for property investing. and enabling people who may not outside of their super have the capacity to invest in a property, but because they've been able to build up a solid super balance, and now they've taken on the role of a self-managed super fund, they can get a property in there. And particularly for some of the small business owners out there who operate through a premise, a commercial premise, the self-managed super fund is becoming a tool that they can use to actually buy the premise they operate from. And that way they have a lot more control over their destination in terms of that business, because they're not fearful that they're going to be removed from that location because they're in control of it. And so the self-managed super fund is effectively opening up the market to more investors, which some may argue is not great, because it puts pressure on the market because there's more people out there buying from an investing perspective. But ultimately we need people in the market to generate supply and demand. And so that's not always a bad thing. And yeah, as I said, it's opening up the property market to more people that may not have been able to get it outside of their super fund.
Andrew, for those out there who want to take a first step into this space, is there anything you want to say to potential investors in the property sector as well? Oh,
look, if you're considering the property investment, you have to do a bit of homework.
Yes.
And you've got to know that you can service the property. You've got to know that you can manage a period of time where it's not going to be rented. It's cold hard reality. There's going to be vacant periods, and you've got to have a plan around why you're doing it.
Yeah.
Because so many people invest in property in this country because of what we talked about at the beginning, which was the capital growth, and they've heard it's a great thing to do.
All the exciting stuff.
And they've seen family do well or friends do well in property, and so they dive into property investing, but they don't necessarily have a plan. And you really need to know why you're doing it and what outcome you're trying to achieve, and then understand how you can get those two to align. And that means you're going to have to do a little bit of research. And we've spoken on Investment Insights before about having processes and systems. Property's no different.
Yeah.
You want to have a process and some criteria that you can use to find the right property to deliver the solution you're looking for when it comes to your personal circumstance.
Very well said by you. Andrew Woodward, I want to thank you for joining me on the program, giving us some insight into the property market. It's an interesting one and one to keep an eye out for.
Awesome.
And a quick reminder that the following program is for informative purposes only. Always do your own research before making any major financial decisions. Get that homework done, as Andrew mentioned. To learn more about how you can master your money, visit theinvestorsway.com.au. And of course, thank you all for joining me right here on Ticker.
You're watching Ticker. We'll have more in just a few minutes.